Hey everyone, I got a really exciting show for you today. I have someone that I've been stalking on Instagram. He goes by the handle of the Millennial Money Mentor. We're going to refer to him as Jose today. Let's welcome Jose to the show. How you doing, Jose?
Hey, Michael, doing great. Very excited to be a part of the show. Appreciate you having me on.
Excellent. Well, why don't you do us a quick favor? Introduce us to Jose. What do you do? What have you done? Went to college, came out. Uh, what is your background that lets you be the Millennial Money Mentor?
Yeah, great place to start. So I always like to let people know I don't come from a finance family. We're actually immigrants to the U.S. from Venezuela. I was very lucky to have the opportunity to grow up in the States and has given me the opportunities professionally and everything moving forward that I'm super grateful for. Grew up in Central Florida, was a athlete my whole life, played baseball, and was very, very blessed with the opportunity to play collegiate baseball on scholarship. I ended up, playing Division I baseball at a school here called Mercer in Georgia, and I had to pick something that I could do while being an athlete at the same time. And was always somewhat decent at math, and I grew up in a not ideal economic situation growing up, so that showed me the value of money and understanding it. So I said, hey, let me do finance. So worked hard as a student athlete, and worked hard to network, and was very lucky to get in front of some people, and was given the opportunity to serve as a financial advisor for a firm here in Atlanta, a well-known financial institution, and worked very closely with uh, you know corporate employees and helping them with their equity compensation, stock options, equity awards, financial planning in general, retirement planning, the whole nine. I was with that for years, and to start my online presence, as you connected with me through Instagram, I've been doing that for about a year now, and I did that because I didn't have the freedom to put out the content that I do now when I was still an advisor. So a lot of people that don't work in finance don't really understand that side of it. So it's more of a decision to forego something that's an excellent career and a big opportunity for me. But I saw the social media as a way of impacting a much larger crowd, and people that probably didn't have the opportunity to study it in school and certainly don't work in the industry. So, when I was with the firm, I had about 20 million in assets under management, which is a nice chunk for someone my age. I'm 26, and got to see a good deal of what happens in the industry of financial planning. And obviously the type of environment that we're seeing now is very serious. So I feel lucky to have some of that experience from moving into this type of environment. So I can talk to people about these types of things and make sure that I can be someone that's more or less trustworthy when it comes to such an important subject.
Yeah. So you're 26 now.
Yeah.
How old were you when you made that decision to really transfer, right? Because you went out of a role that had to be licensed and basically
Yeah.
didn't allow you to contribute to social media in the way
Right.
that you wanted to. How
Right.
old were you when you made that decision?
It was right at a year ago, actually.
Wow.
I was 25, and I got in the industry when I was 23, right out of school. And it was out of nowhere. I started learning about how you could use social media outside of just sharing pictures with your friend and personal branding, all this stuff. I never even thought about the firm I was with. What I was thought was going to always just be what the big leagues wasn't for me. I always
Yeah.
wanted to play Major League Baseball. I didn't quite get there, so I saw that firm as the next closest thing, and I just held it up such a high pedestal. And after you see it and you're in it for some time, you see it for what it is. And I said, you know what, I think I can do something even bigger. So it was tough because I saw the type of money my more direct senior partners were making and that sort of thing. And to completely leave all that to say, hey, I'm going to make videos and make posts on Instagram to people that don't understand finance isn't the most logical thing. So a lot of people didn't understand it, and I didn't get a ton of support, honestly, from a lot of people for it. But it's nice to see people respect it now, and obviously it's still a long way to go. But yeah, I mean, a pretty pivotal decision at a early stage of my career where I had a lot of momentum, what I was already doing, and it was tough. But I think you got to take chances in life, and especially while you're young, and leverage the tools that are out there, and just be someone that can be of value to other people.
Oh man, you have a set of cojones
Thank you.
that very few people do. Because again, you're stepping out of something that you already had 3 years of success. And in that business, the longer you're in it, the more the rewards are. It's just
Oh
how
yeah,
that goes. And you were stepping
absolutely.
into this muck and mire of social media where there are no rules, or very few rules.
None.
And you were just, and you're doing it from a way of service. I mean, I checked out your Instagram a lot more in detail when you said yes to this interview. So, um, I mean, why did you take the moniker the Millennial Money Mentor? Um, because at least at the time you were what, 25.
Right.
No, most millennials don't have a lot of money at that age, right? And
Yep.
but you saw it as a calling, which I totally get, totally respect and appreciate. But talk about that decision, because I'm sure that wasn't even easy.
Yeah, no, it wasn't. I did make a solid investment in understanding personal branding and getting some coaching, that sort of thing. And the person that I approached said, "Hey, listen, you gotta appeal to a certain group, and you have to speak to them in a certain way, and that's how you gain traction with them." So I said, "Okay, well, I am working with people that are much older than me, have a lot more money than me, and they respect me, and that's great. But if I'm going to go on social media with no backing, no one really knows me, I need to speak to a group of people that are on the platform, right? Most of the clients that I was working with weren't on Instagram, but also to a group of people that needed it. So there was a couple different ideas that I had, but I guess the alliteration Millennial Money Mentor, it just kind of rang well to me, and I said, well, let's go with this. And man, a lot of this is just being figuring it out, Michael. It's I don't know. I didn't know anything about content creation or social media or really how to use Instagram. When I made that decision, I just kind of said, "Hey, I'm gonna figure it out." And um, there's been a steep learning curve. I feel like a year in now, I have an idea of how it works and what people are on the platforms for and how to get people's attention. But man, it was a lot of figuring it out, and I'm still figuring it out now. So in all honesty, a lot of that is just me just kind of trying different things.
Very cool. One of the things that I know I wanted to do with you is make sure we talk about a couple of key subjects or topics that will be important today, but probably more important in 3 to 5 years. And the number one thing that I think calls into that category is inflation,
Sure.
right? For millennials, inflation has been a non thing your entire life, right?
Right.
It's been sub 2% really for all of your life, right? And
Yeah.
given what's going on right now with the money printing
Yep.
and all of these things that that we appear to have to do to get through this virus, um, sometimes the medicine has a side effect,
Of
and I
course.
suspect one of the side effects from this medicine is going to be inflation. How do you educate a millennial on the word inflation when they've never experienced? They think it's the big bad boogeyman that their parents or grandparents talked about. How do you have that kind of discussion?
Yeah, and that's a really good point. And I totally agree with you. We haven't really seen inflation, and the only time I've really even thought about it's in financial planning for older people or just like in school, right? So everything more or less has stayed somewhat similar in terms of price, but I think when people just look at the numbers, when I tried to explain the other day about what the Fed was doing with simulating the economy, and then you just look at these headlines and you just think about the fact that all these dollars are starting to be just literally added to the supply of money. Just basic supply and demand tells you, hey, I'm going to need a lot more dollars to be able to afford the same type of thing. So I just, try to break it down and something that's relatable to us. Think about this $16,000 car. Hey, that's going to be, that $16,000 isn't going to be the same car in 5-10 years, that
Right.
sort of thing. And, people just need to understand that A, inflation is real. B, we're probably definitely going to start seeing it more because of what the Fed is doing to step in and hopefully get a handle on this thing. And it's something that we need to start planning around. And I think that there are several ways that you can do it, depending on what your taste is. I think number one, you can own assets that are going to appreciate faster. the inflation rate, which has been 2%. It's probably be higher now. So some asset classes or investments that you can own there, stocks, real estate in your case, things that are just going to appreciate in value over time, because I think a lot of people my age think about having cash in the bank as wealth. And every single year, that historically has been losing about 2% every single year in terms of what you can actually buy, not the actual dollar amount, but what you can buy. And that's what I want people to understand. I saw it a lot when I was running financial plans for retirees, because I would show them, hey, let's look at the cash flow. In year one of retirement, you're spending $50,000 to get by. Great. And year 5 and year 10, that $50,000 is not getting you the same lifestyle. And I'd show them how much we have to pull from the portfolio to live the same lifestyle. And they're saying, well, I'm not trying to take more trips. I'm not trying to buy more things. I say, I understand that. But if things keep getting more expensive, which they are, you're going to need more money just to keep the same level of lifestyle. And when I put it in those terms, I think it started clicking a little bit more for people. So that's kind of my approach towards it.
So let's make this more millennial focused, because I get why the old people get that, right? That kind of plays for me, right? 50,000 a year is not going to be the same 50,000 in 10 years. But again, I was thinking about this as you're going through this, right? Most millennials, when they think about inflation or deflation, they'll just tell you my iPhone's cheaper the longer I wait, right? So they've really only experienced and I'm not trying to be a dick, but
no, it's true. Very true.
Right. But what if you did the graph about what did the first iPhone cost? I don't even remember, but I think it was like $399 or $499. Yeah. And then you talk about the latest one, 12. I mean, that's the inflation that I think millennials will wake up to. If you just
I think so too. I think that's a great example.
Yeah. So I think that's how you can do it. Because again, you got to make it tangible and in their language with their platforms, right? If you just talk about the iPhone 8, it's like, well, it's cheaper now. I'll just wait. No, let's talk about the iPhone first gen compared to today. That shows you what happens with inflation. So just my thoughts.
Yeah. No, that's a great point. And just think about like if the iPhone just came out for the first time in today's world, how expensive it would be. Exactly. Another way of putting it. So that's an excellent way of putting it.
Yeah, because I think I feel terrible for millennials, man. My daughter's a millennial, so I mean I get it. The side effect of the medicine that we have to do today is going to be inflation. I don't see any way around it, unfortunately.
Yeah. I think that's a big reason why the people that are my age that see the stuff that's going on are so into things like cryptocurrencies and that sort of thing, because they're aware of it and they feel some type of way about it, and that's kind of how they feel like they should prepare for it. I mean, listen, to each their own, but in either case, we need to start understanding the fact that I think in our lifetime, inflation is definitely going to start being a thing, and we need to understand what we can do about it.
Awesome. So keep it up. The other one I love that you put out, I scrolled back a little bit, was around impulse buying, or you called it impulse spending habits.
Yeah.
Right. Save. Oh shit, I need this new thing. Oh, save. I mean, that just, you don't get anywhere with that. It's sort of my take on that. Do you agree?
Yeah, I agree. And I think, and this is just me having more time on social media and seeing how things operate. I think that marketers have just gotten better about finding ways to get us to click buy now, and the impulse and getting us to think and make decisions rather based off of our emotions and how things are described, how the products is described. And you think about the world we're in now, where Amazon Prime, it's to your doorstep in 2 days or less.
Yeah.
You can almost pretty much feel that product in your hand already. All you have to do is click the button and it's pretty much already there. Yeah. So I think that those are some of the things that have attributed to the kind of impulse spending, that sort of thing that we get tagged for. I mean, I think that any generation that grew up in sort of environment more or less would probably succumb to that a little bit. But I think that a part of it as well is just an understanding of what you probably could be doing with that money instead of just purchasing whatever that may be. When you think about building wealth, it's a completely different thing than let me just buy something because I like it or think it's nice. When you actually have a reason as to why you're dedicating cash flow to something, I think it's a completely different story. But then again, with people my age, you can't tell them, hey, you're dumb for buying that iPhone. You need to go purchase some shares of whatever company.
Right.
There's got to be a clear reason behind it, and that's where maybe tying it to some sort of goal or whatever resonates with somebody. I think that's much more prudent strategy than just saying, hey, you're silly for buying this. It's no, what can we do with this money that would be more productive? Is it a business? Is it investing? Is it real estate? Whatever. I just think my generation in general just doesn't think that way. Because that's not really how we think about things in general, unless you worked in this kind of capacity. But we have so many distractions in front of us, and it's so easy just to succumb to them. So that's why it's important to think about these things and understand where your money's going and why.
Yeah. So really what you and I know this is called the opportunity cost, right? Opportunity cost of decisions and all of that. But the idea that I want to play with you here is the biggest thing for me, even with my age group, right? So I'm Gen X, right? So my daughter's millennial. I think what we need to do is stop seeing things as dollars, and we need to see them as time. For example, if something costs $2,000 or $200, whatever your number, let's say 200. If you make $20 an hour, that's 10 hours before taxes. And in reality, that's 20 hours, right? Post-tax. Right. How does that $200 thing look if you had to work 20 hours for it? I think that's what we need to talk about more with millennials. We've gotten too much on the dollars. Hey, it's on sale. Use this coupon code, whatever. Buy now, save. So you're looking at, hey, I saved $75 for something I want. We need to educate people saying, how much do you make an hour? And we need to translate everything into either pre or post tax, whatever is easier for you.
Right.
Because a lot of decisions are a flat out no if you tell me I got to work 10 hours for it. I got to work out 10 hours for that dinner that I just had with my girlfriends. No, we're going to go home and buy a pizza and just chill, right?
Yeah.
That's what we need to do. So we need to, if the prices on them had one for dollars and one for time, I think that people would sell a lot less stuff. So marketers probably don't want to do that, but that's how we need to
they don't. They don't. And that's funny you say that, because I more or less kind of play that game in my mind too sometimes. Like, is this really worth X hours of whatever I'm doing?
Yeah.
Is it worth, if you're in sales, is it worth how many ever sales calls it takes to time and effort versus the dollars themselves?
Yeah. Absolutely. So I think that's something, the more and more you can work in to get people to think about, and whether it's a financial goal or some kind of challenge, I think that'd be really, really cool. The other thing I want to talk about that is important for you, it just amazes me, that a 25, 26-year-old is talking about this. So congrats. Is financial goals.
Yeah.
I mean, I didn't even think about it. I mean, the only thing I was thinking about at 25 was, how I could put food on the table and, what's the next thing I could buy.
Sure.
So why don't you talk, how did you come to that? What did you see? Was it all the older folks you were seeing? I mean, it doesn't even compute that you see the importance in financial goals. That's just awesome.
Yeah, I appreciate that. I mean, for me, it just comes from my time in the industry. I mean, running hundreds of financial plans for people and having hundreds of planning conversations and just saying, hey, what's important to you? What are you trying to accomplish? Okay, now let's put together an investment mix that makes sense with that, how much time we have to work with. So in my mind, it makes sense. And that's the only reason why. But, if you think about just any kind of strategy, any type of thing that you're trying to accomplish, whether it's sports, whatever, I think that if you have something that you're aiming towards, at least you have some sort of context. I was an athlete, so you can say, hey, I'm trying to hit 300 this season or whatever. At least that's something that you're working towards. And then you can make decisions that are going to be in line with that ultimate goal. So maybe I'm going to spend some time in the batting cage or, get some extra lessons, whatever. As it relates to finance, maybe you have a goal of, I want to have this in passive income. And this is why I want it. And this is the time frame that I'm giving myself. Now we have some guidelines to work with. And now we have to look at, what are the vehicles that are going to help us get there? Is it real estate? Is it the markets? Is it a business? Is it a combination of all these? And then now it's time to start, really making decisions based off of, your personal circumstances, how comfortable you are with risk, your ability to do one or the other. And now at least we have some context. And I think the word context is incredibly important when it comes to money, because, in an environment like now, if you don't know what you're investing the money for, you're completely new to investing, you put money into the markets and you see it get, potentially halved, you're going to panic. But on the other side, if you're saying, listen, I'm comfortable with putting this money to work for a period of 5, 10, 15, 20 years, that's a completely different conversation. So I think as it relates to goals in general, the main reason to think that way is you have context and you can make decisions that are in line with, and at least you have a reference point. And if you have two things that come in front of you, you at least have the ability to say, is decision A or B going to get me closer to whatever I have in front of me, or, that future goal that I have for myself. So, you can call it thinking rationally about it, however you want to frame it. But I think it just gives you guidelines and it gives you context. And I think that's very valuable.
Very cool. I just want to put this a little more fine point for people watching this. Like when you're talking to a millennial or a coach, or you're advising someone, are you saying, hey, have a 12-month goal, 3-year goal, 10-year goal? Or, what is the kind of brackets you ask them to at least think about?
Absolutely. I think that you should have all three. You should definitely have short-term goals. That may be building emergency savings funds, or paying down, high interest debt, purchasing or putting down payment on a home. All those are acceptable. Medium term, that could be, a large purchase down the road, or starting a business, or acquiring a solid amount of real estate, that sort of thing. And then you can have long-term or more aspirational goals. Mm-hmm. And then, the time is very important, especially in investing, because that tells you how much risk you can afford to take. Mm-hmm. So if you're telling me that you're trying to build a fund for, a home purchase that's coming up in 1 to 3 years, and you tell me, hey, I'm going to go 100% Apple stock on this, I'm going to say that doesn't make sense, right? But if you're saying I'm investing for my retirement 20, 30, 40 years down the road, I'm saying, okay, no, now we're speaking with a little bit more sense. But definitely, and I think the thing about my generation is, quote unquote, retirement is so far away that we don't really know how to approach it, and that's fine. But as long as you know that it's far away, that's much better than saying, I don't know what I'm investing this money for, and I'm just going to throw it at the markets. But I think that having that structured kind of tier of goals is very important, because, you have things that are important now, and you have things that are going to be important down the road. And obviously it's not always going to be the same, and you got to be able to adjust, but at least having that framework, I think that helps a lot.
Yeah. So one of the things we got to talk about, given we're both, gosh, I've been following money since before you were born. Jesus Christ, I'm old. But anyways, so you were a teenager the last time the market kind of rolled over, right? Just doing the math.
Yep.
This is the time you're investing. You're seeing it up close. You're seeing kind of crazy things, right? Record down days, crazy up days. How would you tell a millennial who in the last, what is today? Today, Tuesday? Last 7 days, there have been 7 moves of 1,000 point or greater. Is that that hurts my head to say.
It's a lot. And my entire just behind all this is what we're seeing. I think that we are seeing just completely new markets compared to what we've seen in the past. And what I mean by that is the world is different. You think about how quickly information moves right now. Someone gets sick in Sweden with the coronavirus, you find out about it in seconds if you're on Twitter, right? And you combine that with algorithmic trading, all these machines making all these trades based off headlines and different patterns and all these different things. It's no surprise to me that we saw both the fastest correction and I believe bear market in history, because you combine the speed at which information moves right now and all those other things like high frequency traders and algorithms, everything is playing into it. I think that it's a real recipe for volatility. And for someone that's newer to investing, I think it's important to understand that I think investing is definitely getting riskier in a sense, at least in these types of environments. So I was just, I try to keep up with people that know a lot more than I do. And a lot of them just have shown historical patterns about these types of things. And the one thing I see is the road to the bottom is usually bumpy, like it
Yep.
was in '08.
Mm-hmm.
Like you mentioned, I was a teenager. I was trying to make varsity baseball as a freshman. That's all I cared about. But back and look at the chart, and you look at August, and it looked like, hey, this thing is over, and obviously it wasn't.
Yeah.
S&P ended up almost 40% down for the year, which is very scary to think about. But it just shows you what's happened in the past, and it's not out of the question now. But then you see the recovery, and you see the value of playing it for the long run. And I fully believe in our ability to recover from this, and it might just take some time, but if you have time on your side, you can see this environment as an opportunity, number one, to potentially pick up some companies that are trading at what you could consider to be a discount. And even if you are just investing in the general S&P 500 or American economy, I would much rather buy at these prices than a month ago, right? And you can spread that timing risk out by just doing what we call dollar cost averaging, just putting money to work just over time. That way you're not throwing it all at the market at once, and we see another down day where it's down 1,000 points and you're freaking out. So it's much easier to say it than to do it, but I think it's important to see these types of things as an opportunity to truly buy low and hopefully in the future sell high. It's just, as humans, it's easy to do the opposite, right? We want to wait until it recovers, and then we want to buy, and then when it starts dropping, now we're gonna sell. I think that's just one of the better ways of approaching the environment that we're in right now.
Yeah. One of the things I knew I wanted to ask you, if this conversation went well, and it's gone well, so I'm going to ask it.
Thanks.
Is one of my theories that I've kind of thought about just the last couple of days is something that my generation almost became gospel, right? Buy the index funds. Just bet on the market, right? Buy whatever index fund, low management fee, and just don't even think about it, right? I believe what has happened is that, combined with high frequency trading and all these triple ups and triple downs and all these other things, has created an environment where everybody is in a theater that's overcrowded, but they didn't add more exits.
Right.
So somebody yelled fire, and then somebody else yelled fire, and then somebody else, and pretty soon people are getting out, and then you have 3,000 point down days. So the reason I bring that up is I unfortunately think that the day of the index fund has kind of seen its heyday. I think it will be written up in months to come as the problem. But the answer is, you need to think stock picking. I mean, stock picking has been a dirty word since 2008, and it was a really dirty word into the .com crash.
Sure.
But I think that's going to become the topic of the day. Am I nuts? Am I just overthinking it given the chaos, or what are your thoughts on that?
No, I think that's a really good point. I mean, I've definitely seen a lot of people pointing in that direction as well. Looking at things like bond ETFs failing to track their index by several hundred basis points. That's scary to see. I mean, I think that it shows the challenges of trying to make an asset that is more or less illiquid, like just corporate bonds, trying to make it liquid. I definitely see what Michael Burry was talking about in that case. He's kind of been saying that there's been an ETF bubble for a long time, and I didn't really pay attention to it at first, but now I'm starting to kind of see when things start getting a little bit crazy, it becomes a recipe for these types of things. I think potentially it may still be okay in the more liquid areas, just large cap, publicly traded kind of companies. But even then, it's not completely safe either. You're still seeing very, very substantial drops. I think that the misconception is that index funds and ETFs are safer. They're not necessarily safer. They just give you more diversification in some cases. But I think that there is a lot of talk about the need to be able to, like you said, owning quality companies, right? Just the ability to just look at a company fundamentally. You don't have to be Ray Dalio, you don't have to be Warren Buffett, but just look at the fundamentals and say, is this company in a solid financial position? Okay. Is it good at what it does? Okay. Does it have solid management? Great. What is it doing to increase its earnings, what is it doing to be a more valuable company to its
Yeah.
customers and shareholders? I don't think that is a very difficult thing to learn, right?
Yeah.
I mean, you got to learn some things about it, but I think that sort of thinking is going to be more appreciated because you don't have, like you said, that the crowded theater type of environment when you're owning individual companies. But I think it's going to take us getting out of this thing and then really reassessing.
Yeah, we got to get out of this thing first. But again, it was so it sort of started to break apart yesterday. But the first kind of 5 days where there were just 1,000-point moves, everybody was going up and down the same percentage. I'm like, how can every company be as good or bad? I mean, that just doesn't mathematically make sense, right? And that's the problem when everything is index funds, is everything gets sold at the same time or gets bought at the same time, depending on what side of the equation you're on. And I'm like, that's just wrong. So the idea, I think, going forward for 2020 is, okay, find the companies that are inadvertently punished because they're a larger component of indexes,
right?
And then go buy them individually. Because I think millennials today, if and when we get through this, and you have the guts to pull the trigger, you will find the buying opportunities of a lifetime.
Yeah, I agree. I think that we are either in it or close to it if we're not already at the bottom. Any time within this window, I think that there are definitely going to be some very, very attractive opportunities for people. I just want to make sure that obviously people are covering their bases first, because I think kind of a thing that I'm seeing on social media is because it's such a good opportunity, there's almost a sense of fear of missing out. And I had someone ask me today, hey, should I be day trading my liquid savings, my emergency savings account? And I was just like, I don't come from a place of judgment. I was just like, hey, listen, that's just not a good idea. That's something that you need to have regardless. So I just want to make sure people have that covered before they think about throwing all their savings at something. But if you have some capital on the side right now and you don't have a better use for it, I think that, like you said, there are going to be some great opportunities if they're not already here now.
Yeah, there's one other thing that I knew I wanted to talk about with you is, and again, you could just tell me to F off. I don't care. I think there's been a couple of momentum stocks that millennials have jumped on, and that is so dangerous. Tesla comes to mind first, and then that kind of had its day. And then this rocket company, I'm drawing a blank on the name.
Branson's company.
Yeah, Galactic or something.
Galactic. Virgin Galactic.
Yeah, whatever it was. Some place going to Mars, right? Whatever it was. And it just went up like. That's one thing I would coach people on is that has never ended well. Right. I've been through a lot. That was so easy to call as somebody who survived the .com crash. Something goes parabolic with no real news.
Right.
That's a problem, people. That's not normal.
Yeah.
That would be something I would start warning people on, because it just happened twice. And then we got into this environment. So maybe it's over, but I saw those two things back to back. I'm like, God, they're doing it again. Because for me, it was pets.com and Webvan and all these things that couldn't miss. Everybody's got pets.
Right.
You got to how would you like food delivered, right? Because before Amazon, there was this thing called Webvan that got like $2 billion and burned through it in like 6 months. So
right.
I don't know. That's just something I knew I wanted to bring up. You think that's true?
Yeah, no, and I think that's a good point, because I got plenty of messages about it when I was going on, and no one wants to hear, hey, let's be a little bit more rational, because you're seeing it shoot up just insane amounts, and if you say something like that, then you're kind of labeled as someone that doesn't know what they're talking about. I guess it just kind of comes with territory, but I just, going back to just like the fundamentals, for the longest time, it might still be the case. I remember looking back at the PE of Tesla and they didn't have one because they didn't have earnings, right? It was still negative. So, that sort of thing is concerning. If you're making some more risky type of moves, you're swing trading or whatever, just be careful how much of your portfolio you dedicate to it. I'm not big into day trading. I'm not big into the foreign exchange, all those things that a lot of my generation is into. I'm just not into it. And if you are going to be trying to make these risky plays, you need to understand that you can only risk so much of the portfolio you've already built right now. You've worked so hard to build, because we think that if we lose 5%, we got to make 5%.
Mm,
Obviously, that's not how it works. You got to make more just to break even, the
yep,
more that you lose. And
absolutely.
until you actually look at the math, it doesn't make sense. But that's just how it works. And I think when people understand the value of consistency over chasing returns, it makes sense. But that's just not sexy, and that's not what does well on social media. So, you got to kind of find a way to talk about these things where you appease the fact that, hey, people are excited about it, but then you got to say, well, listen, let's think about this rationally as well. So
Yeah.
that's something I'm still working towards and working through.
Yeah, the thing I'll put out there, and again, I understand you can't, but I can, and because I don't care. People that are chasing these kind of momentum stocks, I don't mind that you do it. I mean, I did it once back in the day, and I lived really, really well until I didn't. And then I lost six figures, and
Yeah.
you want to feel bad as a 26-year-old, go lose 100 grand.
Yeah.
Um, you can do it, but don't you dare call yourself an investor. That's where I draw the line. I have
Right.
no problem with people going to Vegas and gambling. If you want to go to Wall Street and gamble, go for it. Just don't
Right.
you dare call yourself an investor. That's where I draw the line. If you want to go
Yeah.
gamble and have fun and day trade and do all this stuff, awesome. Go for it. Have fun. But don't you dare call yourself an investor. That's what I think.
Yeah. And I agree. I think, I guess people consider it more old school when it comes to it, because day trading and these types of more risky things get just a lot more attention on social media. I think it's just because of the way these platforms are built. They're just built to like show the sexy side of things and just like what's exciting and what that big trade was. That is much more likely to get shared and people much more social space on social media. Is that's the sort of thing that really gets attention. And I think that's why our generation in general looks at these things as viable ways of building, consistent wealth. So I just urge a lot of caution
Yeah.
when you're, thinking about those types of things.
Well, Jose, this has been so much fun. How can people follow the Millennial Money Mentor? Obviously on Instagram, which is where I found you, but where else are you?
Yeah, so I'm actually starting to be a lot more active on Twitter. I use it kind of dynamically. I use the screenshots just for Instagram, but I'm trying to connect with people on there as well. I'm just double checking the handles. So on there, it's at Jose and then underscore TMMM. So the Millennial Money Mentor. Yep, Jose underscore TMMM. Pretty active on there as well, but I try to be very consistent on Instagram. Always checking direct messages. Always appreciate when people engage with the content, ask questions on there. Obviously, share it. That means a lot as well. So, between Instagram and Twitter right now, I'd say those are my most active.
Very cool, Jose. Thank you very much for what you do. I'm still amazed that at 25, you made the decision to leave a potentially 7-figure career path
Yeah,
to go help people.
yeah.
That is amazing. So
I appreciate it. Yeah, I still have a long way to go, and there's definitely business intentions behind it, and there's things that I'm trying to accomplish as well. But I definitely just want to be someone of value to our generation. Being someone that doesn't come from money, I definitely understand the value of it, and that's why I'm so comfortable being someone that can be open about these types of things. So I really appreciate the opportunity to be on the show, and you even thinking of me highly enough to be on it, man. So I appreciate that.
you got it, man. Take care of yourself and have a wonderful day.
Hey, you too.